Every single Wednesday, we do a live stream called Chart Day in our private community. Here's this morning's recording, raw and uncut. Enjoy. It's Wednesday, July 2nd, and time for another edition of Chart Day. I'm your host, Eric, Mr. Fired Up Wealth. It's our last stream of the week. We have 4th of July holiday on Friday. U.S. markets are closed. Today, we are going to cover, like we always do on Wednesday, we're going to look at the S&P 500. We're going to look at the NASDAQ 100 and 20 individual stock tickers chosen by community members. Of course, remember that we are long-term investors. We are buying and selling stocks based off these technicals as long-term investors. So we're looking at yearly charts, daily candles. We're not using technical analysis for swing trading or day trading. And 99% of the puzzle is fundamental analysis, both qualitative and quantitative analysis that we teach in the Masterclass series. Now, I think today will be an important psychology reminder from the masterclass. And thank you, Taurus, for letting me know. And really just the community in general. And a reminder, guys, we're here to teach you how to fish, how to be a better investor, hopefully be a better person, a better version of yourself, and prepare for your financial future, having financial freedom, and a better life for you and your family. That's what Fired Up Wealth in our community is all about. Now, we had a good conversation yesterday about which stock should we buy. Everything seems expensive. Prices were a lot lower in April. What do I do if I'm a long-term investor? Well, each person is going to be a little bit different depending on your age, your timeline, your suitability, your blueprint. And the blueprint is really important. The blueprint's there, sort of like guardrails so you don't drive off the cliff. It's to keep you in check so you don't start making bad decisions. And I will tell you, in a market like this, you will make bad decisions if you're not on your game. This type of market is going to drive FOMO. It's going to force you to buy stocks that you normally wouldn't buy because you see them go every day and you see those dollar signs, but you don't really do the homework. You don't do the due diligence. You just assume, oh, this is going to be a good stock because it keeps going higher. But if you look under the hood and it's 400 price to sales, it has no revenue, do you really know what you're buying? So we're going to go through some of those charts today. Before I get started, I want to actually front load this a little bit and talk to you guys about anchoring bias. Behavioral finance term to describe a rational bias towards an arbitrary benchmark figure. Okay, what does that mean exactly? Now, if you think of it from marketing and sales, right? Anchoring bias. This can skew our judgment and prevent us from updating our plans or predictions as much as we should. So anchoring effect or anchoring bias. This mug is $300. Hey, this mug was $1,000. Now it's on sale for $300. That's like free money. This is how they get you. Amazon Prime and Black Friday and things like that. Sometimes they are good deals, but a lot of times, even on Amazon Prime's coming up, I've seen prices where I looked at something 2 weeks before and it was $500. And now it's like $499 and they change the price and make it look like it's cheaper. And this is a psychological thing that if you're in sales and marketing, they teach you how this stuff works. Our brain is really interesting. But the reason this is important is it impacts how we invest, how we manage our money, which is important, which is why you're here. So if you look at this, this is actually from Google Gemini. So it's good to see Gemini using AI in the search bar. The question still, though, is how are they making money on ads? Because I'm not going to click on some blog that has ads now. I'm just going to go here. So how is that model going to be impacted? That's the question with Google. That's a different rabbit hole. So anchoring bias. So how this impacts you when you think of investing. You may be fixated on a higher historical price. So you might remember a time when the stock was trading at a much higher price, and therefore you view the current low price as a sign of weakness or poor performance, even if the fundamentals are sound. So this might happen in 2021. There are some stocks that were really expensive. You might have bought it, sold out in 2022, buy high, sell low. And now you look at it and say, well, that thing's garbage. I'm not going to look at it again. And I'm the same way. I get it. But that will give you that kind of anchoring bias. You're fixated on a higher historical price. You remember a time when the stock was trading at a higher price. You view the current price, basically the stock is trash, right? This is the one that I really want to hit home. You may be reluctant to buy after a price increase. This is the one we were talking about yesterday. So if I bought Tesla at 175, why do I want to pay $300? Well, because you want to add more because it's going to be worth more later. Well, this is where the blueprint comes in. If you allocated 3% of your portfolio to Tesla and you're at 3.15%, you don't necessarily have to add shares. And this is where it can get tricky because your mind starts saying, well, I wanted 3% when I did my blueprint, but now I'm willing to go to 6%. And you start basically driving through those guardrails off the cliff. That's why the blueprint's there. It's there to establish the guidelines up front before you start buying, before your emotions start getting tied up into your buying decisions. You have to understand this, right? But this is when you're reluctant to buy after a price increase. The stock's already risen significantly from previous lows, like April. You might be anchored to that previous low price and hesitant to buy, thinking you've missed the opportunity. Does that hit home or not? 100% what's going on right now. Now I'm going to show you the SP 500 and I'm going to show you the QQQ. The market's probably going to go higher. With that said, we do have futures turning red this morning off of this jobs report. Private sector lost 33,000 jobs last month, according to ADP. That marks the first monthly decline in ADP's payrolls since 2023 March. And economists pulled 100,000. So economists pulled 100,000 growth and we lost 33,000. That is a big number. And normally you would see the market selling off like 5%. And it's basically down a little bit, 0.39. Why? Well, because the market, the president wants Jerome Powell and the Fed to cut rates. This is going to give an excuse, another reason why rates should be cut. Jobs are going the wrong direction. The economy is actually not in great shape. Now, the stock market is interesting because the stock market sees rate cuts as a tailwind, which it is. But it's a slippery slope and it's a fine balance because we could go into a recession and unemployment could spike. And those things generally are lagging indicators. You start seeing negative, it's bad. This is why I have some cash. This is why I tell you there are risks if you're buying the S&P 500 at 6250. Can it go higher? Sure. The technicals are going to show you that there's still momentum higher. There's lots of excitement in the market, lots of retail frenzy in the market. People that have never invested in their lives coming out of the woodwork with new money. There's also a transfer of wealth that's happening now, and it's going to continue for years. And that's transferring that wealth, record-setting trillions of dollars of wealth, billions of dollars of wealth from the boomers. I'm not sure the exact number, but it's a lot of money. From the boomers, right, to millennials, to Gen Xers, Gen Zers, whatever. There's a transfer of wealth of these people age, the boomer demographic ages, and as time goes on, they're no longer with us. That money gets transferred down, and that's going to be spent differently. The market wants to go higher. People want to participate in the market. It's cool to invest in stocks now. It's just cool. If you're 25, it's cool. My buddy invests in stocks. That was not the case when I was 25. You were like, oh my God, what's wrong with that person? What's wrong with Eric? Why is he investing in the stock market? Those guys in suits are there to take your money. Tesla reports 14% decline in vehicles, marking second straight year-over-year drop. And you wonder why, hey, let's go buy Tesla. Yeah, I like Tesla, 175 or less. And this is actually up 5%, $318. And this is exactly, I don't have all the information. This is real time. This is live. But this is exactly what I'm talking about. The market wants to go higher. It doesn't matter what the news are. It doesn't matter if the jobs report comes in bad. It doesn't matter if there's a 14% decline. We want to go higher, right? Could we still have a breakdown? Sure. Right now, I'm telling you that the market wants to go higher. I'm going to show you the charts. So if you look at the bonds, 10-year treasury, 4.285, oil sitting at 66, up 1%. Gold, 33.55, still up there. Bitcoin pushing 108,000 here. So the first thing we always do is we're going to look at S&P 500. That's the SPX. And and you see orange, that's previous chart days. It gets messy because we do these every Wednesday, right? You got the Fibonacci pivot points, and that's going to be basically S3 to R3. Keep in mind, there's an old Fibonacci pivot point on the left. We want to look at the ones that are on the far right. So anything in yellow is going to be today's chart day. And you can see SPX. This is the S&P 500 index. Further advance is expected. This yellow circle we circled as we were coming up, saying it's probably going to come up here. And look at the top of the circle. How many times did we do chart day and say, hey, here's a circle up here. It's probably going to go here. It's probably going to go down here. How many times did it happen? It happens a lot. We're very accurate. And this helped us be better investors to get better prices, right? And it's good to be disciplined. That anchoring bias we talked about, it's good to be disciplined, but I remind you that it's a slippery slope, because if you're looking for the same prices as April, you might not see some of those again. Or, maybe you do, maybe you don't. Right. So you have to be okay. Invest if you're buying right now, buying these prices, knowing it always could do something like April again, and that you would buy more. And that's why that blueprint methodology that Fired Up Wealth teaches, why it's so impactful, because it sets you up to win no matter what the situation is. Right. But expect 62.30. The R2 is 63.12 right here. Okay. 63.12. And this R3 is 64.47. So it's possible to see this next range. Of course, the market could break down anytime. It depends on the news, but right now the market wants to go higher. I told you on Monday that sometimes 4th of July, you'll see a pump in specific stocks. You'll see a dump. You could see the market go higher. You could see you could see some volatility after the 4th of July holiday next week, especially in some specific retail names, as people get together and shoot fireworks and drink beer and say, hey, did you buy Palantir? It's going to $5,000 a share. Oh yeah, I'm going to go buy some more Monday. That kind of stuff does happen, right? So next we're going to look at the QQQ NASDAQ 100. All right. Same kind of deal. We circle this yellow circle here and said, hey, this is where we're probably heading next. Boom. We're at the top of that yellow circle. QQQ. So we drew this up last week, this yellow circle. R2 is 562. That is going to be right here. R3, that's $576.97. And so our next circle that we'll draw up here is somewhere in there. That's where the market wants to go, the S&P 500 and for the QQQ. Another rabbit hole I could go down with anchoring bias also deals with buying against the grain. If I showed you this yesterday, I'm just going to show you really quick. I won't go too deep of a rabbit hole on this, but I brought this up yesterday. And the reason I brought it up isn't to try to brag or anything, but it's really, I'm always trying to think of lessons to teach you guys stuff about the market, help you be better investors, right? If I look at the dividend portfolio, it actually closed up even higher than this. It's up over 10% year to date on this portfolio. And so 10% year to date, as of yesterday, the VU is up 5.43. It's actually closer to 5% maybe now, 5.2 with the futures and yesterday. And the QQQ up 7.29. It's going to be less than 7%. And the dividend portfolio might come down a little bit too. But you get we're basically doubling the S&P 500 with the dividend portfolio. Why am I sharing that? To show you how well buying against the grain works. If you're buying dividend stocks, you're expecting to underperform the S&P 500. You're buying those dividend stocks for passive income. So Dave yesterday shared yesterday, redundancy. So I shared this. There's that word shared again. I posted this. Morningstar released their 10 best dividend stocks to buy. Here's the list. Dave replies, well, that's great, but Medtronic actually has 5-year return of negative 16.97%, where the VU has a positive 73%. VU significantly outperformed. It outperformed pretty much all of these. You can look at it, except maybe Exxon. Exxon crushed it, but that's because we had a ridiculously low price. This is using the pandemic prices where oil was negative. So this is an anomaly that you shouldn't expect again. But remember, the VU is accumulation phase. S&P 500 is part of a core for accumulation for a young investor. It's not necessarily the best thing in the world for retirees because it only pays you a 1.5% dividend. I'm not defending any of these dividend stocks, right? But they perform this way. These are income stocks. A couple people asked me to look at income stocks today. We're going to look at those in a second. But these are for end game retirement. You don't buy, in my opinion, Medtronic if you're 25 trying to accumulate. That's not the kind of stock I want you to focus on. Of course, we want to buy dividend stocks that perform well. Medtronic's been a dog. It's a good company. The stock's been a dog. But we still want to do well. We want to buy stocks that perform well. And if you look at the portfolio, this is doing really well. Now, my expectations aren't that this is going to happen. Yesterday Hershey's was up 5.74, Target up 5. All these stocks were ripping against the grain. When people are chasing those growth stocks, I already bought them. When people were buying these stocks back in 2022 or what have you, and now, and even earlier this year, 2025, people are buying growth stocks that we already owned. And I'm over here putting $150,000 in this portfolio against the grain. And now my main is outperforming because I had those stocks before the masses popped in. And the dividend portfolio is also outperforming because I was buying against the grain. But the anchoring bias and the psychology really ties into all this stuff. Psychology, I talk about it in the masterclass, video series. Psychology is one of the most important things you could possibly learn. Even if I look at the Goals Inspiration channel, I posted here a lot too, guys. Look at some of this information in here. So psychology, number 12. I believe that psychology, this is the 20 things I learned in the last 20 years. You can read it in the Goals Inspiration channel Discord. Psychology may be the single most important topic for a person to learn in order to be successful. I truly believe this. From emotional intelligence, understanding your friends and spouses and their feelings. And, there's so much politics that goes into life in general, especially if you work in corporate America. Understanding emotional intelligence, but also personal discipline. And that can be buying stocks. It could be whatever. It could be your job. It could be diet and exercise. And we all have our flaws. I'm great in some areas, and I definitely am not perfect in other areas. I'm human, right? But psychology literally can change your life. If you believe that you can do something, there's a good chance you're going to be able to do it. If you don't have confidence in yourself, nobody else will, right? So if you look at the number one rule on here, self-esteem is critical. If you don't believe in yourself, don't expect anyone else to. This is the kind of stuff that I've learned over 20 years when I was young and hungry and thinking like, why is the world this way? And, who made the planets and who made God and all this stuff that goes through your head when you're 16 and 20 years old. I haven't figured out the universe yet, but I have figured out a lot of things along the way. And I'm trying to share that information with you to help you be a better investor, but a better version of yourself too. So let's get into 20 individual stock tickers. The first one's from Riverboat Gambler. I don't love the name because I'm not into gambling or riverboat gambling, but it is comical. OKLO. The name suits you. No offense, Riverboat Gambler, but this is Riverboat Gambling right here. The fib range is $30 all the way up here to $87 on the R3. So you got the S3 Fibonacci, R3, and all the lines in between. These are Fibonacci pivot points. And if you look at this, let's look at it, right? Would you look at this? Would you look at that? Okay. So this went public. Let me guess, probably a SPAC. I don't know. Based on the price, this $9-10, it was probably a special acquisition corporation SPAC type deal. So July 2021, sitting here doing nothing. Oh, look, the SPAC went through. It pops to 18 and then sells off to 535. And I'm just guessing. I don't know this company. I'm just guessing this was a merger, went to $18, the pump and then the dump to 535. You bought at 18, you sell at 535, buy high, sell low. Well, then it rips to 59 and you're like, damn it, I should have sold at $5. So you actually lost, 70% of your investment here. And if you would have just held on longer, you would have 10x'd. But does it pass the sniff test? What is the sniff test exactly? Well, this went from 5 to 59 to 73. So these guys must absolutely be crushing it. The revenue growth must be out of this world, right? Maybe. Let's look at it, right? This was $535, September 2024, then $73. Does it really benefit the way the market thinks it will? That's our job as an investor. The chart's not going to tell us that. So let's just go look really quick at Seeking Alpha. Profitability. Oh, they don't have any. In fact, they're burning $495,000 net income per employee. Well, red flag there. Let's keep going. Growth. Well, it doesn't have any growth. Well, what does that mean exactly? How can you not have any growth? Does that mean they don't have any revenue? Well, what's the valuation? Well, it doesn't have a P ratio. Of course, it has no revenue. So we're talking about a 20 forward price to book and no price to sales. So again, this is telling me there's no sales, there's no revenue. How in the world am I buying a stock that has zero revenue? What's the story here? Short interest, 10%, $7.63 billion market cap with no revenue. What's going on here? So let's look at that. So OKLO stock. We'll just go to Google. It's really simple. You click finance right here. You scroll down and let's look at how much revenue they brought in last quarter. Well, guess what? They brought in zero revenue. This doesn't make any money. So people are paying $73 for a stock for a company that makes no money. So this is completely a story. It's a meme. It's a spec. It's probably going to lose you money unless that story really comes to fruition. You know, if this story comes to fruition, you can still make money. But then I ask you, if it's trading at 20 forward price to book with no revenue, how much excitement's already baked into the damn thing? Probably quite a bit. This is an absolute no touch for me, right? This is where that FOMO and the retail investor, the retail trader gets you all hyped up and jazzed up over stuff that's just dog, right? And I don't mean to offend you if this is your favorite company in the world, but it has no freaking revenue, guys. So headquartered in California, innovative company, dedicated, blah, blah, blah. You know, STEM was innovative in the energy space too. And look what happened to that. You know, I mean, it's spec 10x or 0. You know, it's rolling the dice. You're a riverboat gambler. Go gamble on it if you want. You know, STEM is actually back to 636, and that speaks volumes of the market we're in because, you know, this thing has got negative 27% growth. The market is just drunk again. Be aware of it. So anchoring bias isn't necessarily bad, you know, but remember, realize you have to separate the high quality companies from the ones that are pure speculation. And I'm not saying you can't buy pure speculation. That's why we teach in the masterclass 10% spec of your portfolio, have 10 to 20 stocks. So you can put 0.5%, maybe 1% in your portfolio, knowing you can lose it all, and that's okay. But that's how you treat these companies. But you still have to understand that you're paying a huge premium at $51 for something that has not made any money yet. Woo! All right, Shopify. Fired up wealth favorite, great opportunity in April. So again, you know, it's $69.81. When I have an anchoring bias, I don't want to buy it unless it's under $69, you know, under $70. Well, it might not happen again. And maybe it does, maybe it doesn't. But what could happen is it could go to $150 and then pull back to 100. Now you're buying it at 100. Well, you could buy it at 111 now. You know what I'm saying? So sometimes discipline and patience isn't so bad. What I have to look at is look at the fundamentals and say, what do I think it's worth? Now, this is the tricky part. If you're new to investing, I mean, Wall Street analysts can't even figure it out. Kathy Wood can't figure it out. I don't expect you to figure it out. And I'm not saying that I'm the best in the world at it, but I'm pretty damn good. If you say, what is Shopify really worth and what should I pay for it? I can give you an answer if you give me a couple hours, right? And I think the answer is probably not, I'm going to pay $111 for it. Most of us own it in the 60s. This is where we're accumulating these kind of stocks. If you want to buy it, buy it. Understand it could go higher and it could go lower. It's probably going to go higher. If I look at the charts, I look at technicals, unless the whole market breaks down. And keep in mind, if the market breaks down, all bets are off for all these charts that we look at today. But if the market continues to remain bullish, then under 760, now one, you know, was under 70. Hold on. This was under 70, now 112. But this R3 is 126.39 right here. That's the R3. That's the new R3. There's also an old R3. And then you could see a retest of this previous high, 129.38. I think you probably see, if you want my opinion, you know, not financial advice, yada, yada, kumbaya. 133 to 139 is what I kind of eyed last night. So I'll even use this one so I can refer back to it. But I think it's possible you see up here, you know, the first step's going to be somewhere in here. Upside. But always look at the risk reward and say, do I want to pay 111 when I know there's going to be resistance around 130 because that's the previous all-time high? For me, not really. If you're thinking about 10 years out, it's probably a hell of a buy at $111. Do you have the psychology, though, to understand that and to ride that storm? In other words, you buy this at 129 thinking this is a great investment for a 5 or 10 year hold. And the answer probably is true. It's probably correct. But then it falls off a cliff and loses half of its value overnight in April. And you say, oh my God, investing is terrible. This is the worst thing ever. I'm selling everything. I'm taking my ball and going home. So you bought here, you sold here. Well, you give it a little bit of time. 3 months later, it's pretty much in this, you know, getting closer to the ranges you paid for it. But if I zoom the lens out 5 years, that chart's not going to be straight up to the moon, but it's probably going to be worth more money. But do you have the psychology and the ability to overcome the anchoring bias? And does it ultimately fit your blueprint? And that's what really is it all about. If it fits your blueprint and you have to have 5%, well, you're periodically dollar cost averaging. You're not worried about the fired up wealth technical analysis lot allocation strategy that we're discussing right now. SPG in the place to be. Now, this is an income stock. So, I mean, I'll cover it for you, but here's the deal. If you give me an income stock, I'm going to say, hey, this is an income stock. It's a REIT. All REITs are income stocks. Pays you a 5.23% dividend. You own it for the dividend. Now, I just got done showing you the dividend portfolio. And obviously, I'm still trying to buy the stocks at the best prices, which is how I'm able to outperform the S&P so far to year to date. And again, I want to repeat, I do not expect to outperform the market ever with that dividend portfolio. If I do it, it would be an anomaly. I'd be shocked. I'm focused on income, not on performance, not on alpha. I'm focused on end game preservation and income, not accumulation. You buy Simon Property Group as an end game income stock, period. You don't buy it in the accumulation phase, in my opinion. Now, you can do it to diversify and help maybe create some lower volatility, lower beta, but does this really do that? I don't know. This was pretty volatile, 190 to 136, but probably has less beta than the average holding, especially a tech stock. So just a quick search, it's showing 5-year beta 1.49. That looks actually pretty high. So this is it's interesting. Beta, the VU beta. Let's try SPY beta. So this is a 1, obviously, right? Because that's the market. Duh. So obviously the S&P 500 is going to be 1 because you're comparing it to the market. That's what the beta uses as the benchmark. This is 1.49. So that's quite a bit of beta. I mean, if you look at something like I don't know, Snowflake, for example, your beta on this is actually 1.21 according to Yahoo Finance. So this is telling me it has more beta than Snowflake, which I never would have got right on a quiz. I don't think you would have either. And maybe Yahoo Finance is wrong. We're just doing this on the fly live. But the point here is it's not really fixing your beta. Has this crushed the market or something? Let's look. Right? And obviously past performance doesn't guarantee future results. 138% over the past 5 years. It's actually done pretty well. But remember, you're coming out of the pandemic. And so this is the chances of you getting the same return are basically 0. Because this is literally going back to the heart of the pandemic, July of 2020. So when you look at these 5-year charts, be very aware that this was the heart of a pandemic, and certain names like Simon Property Group that are real estate, that are going to have exposure to things like shopping malls and outlet centers. So this was absolutely hammered. So if you look at the chart, guys, 2020 is $48. I mean, this is going back to 2009 prices. So 11 years erased. And I talk about this all the time. Having patience and anchoring bias isn't always a bad thing because, you held this thing for this long and you had no way of knowing there's going to be a black swan event. Now, of course, if you're still bullish on it, you just hold through it, but this is still painful right here. You're not going to panic sell here if you believe in the company. And if you held on to it, it took 5 years and now you're kind of back in those levels. But in 2016, this was a $215 stock. So it's actually not even close yet at 164. Do you get where I'm going with any of this? This 5-year return, you're not going to get 138%. I'd be willing to bet you get something like 20% over the next 5 years, maybe more, but that would be my expectation if I bought the stock. And then if it outperforms that, then icing on the cake. That's how you have to handle these type of names. You don't go into it saying, oh, this is up 138% last 5 years. I'm going to buy it today in 2025 and it's going to do it again. No, it's not. This was during the pandemic, right? So you buy this as an income stock. Here are your ranges, Fibonacci. The current R3 is 168.25. It probably goes to there right now. The market opened. You can see things are selling off a little bit after this jobs report. Let's see where we're at. Basically flat. Like I said, the market wants to go higher. The market's probably going to go higher. The VIX is still under 20. It's at 17.29. Excuse me. Okay, so this was an air pocket. This is a more attractive buy, obviously. And now you're here. This is probably way too expensive. This is probably the buy area. Do you want to pay 164? Ultimately, do you want a 5.23% income stock that acts like a bond that doesn't give you a lot of accumulation on the share price over the next 5 or 10 years, more than likely, right? And understand that it's also very sensitive. You get another pandemic or something. These are the kind of names that get absolutely pummeled. That's when I'd probably buy it if that happens again, right? This is ALGS, highly speculative. Range here is $3.76. And I love chart day because we get, I love all the picks, guys, because it's such a teaching lesson when you see something like this. Okay, this thing was $6.76. So not a penny stock, but it was a penny stock here recently in April. Just in April, it was $3.76. This thing rockets this from $7 to $47. And I understand, right? You look at this and say, well, this is the kind of thing I want. I want to buy here and sell here, and I'm going to make a bunch of money, and then I'll find another one of these. And this is what retail investors are trying to do. They're trying to chase these type of things and get rich quick. The reality is, if you chase this, it is bad for your health, and you will lose money long term. 99.9% of people that are chasing get rich quick, they might get one or two right. They're going to lose big. They get addicted to it. Trust me, the addiction is real. I've been there. You don't want to get addicted to trading. And ultimately, the house is going to win, just like in Vegas. But let's go through this. Let's talk through it. Let's learn something together. The range here is 376 right here to 46 on my chart. That's absolutely ridiculous. It's not profitable or bot profitable if you can't type at 9 o'clock at night on a Tuesday. It's burning cash, negative growth. This is biotech, which is kryptonite. I try to avoid at all costs. These are very, very hard. Pretty much all these names are like you can get a 10x, 20x, or you can literally go bankrupt overnight. You can see that it's down 4.73% here in this market. Was up yesterday 2.5. Profitability. Well, we don't have any numbers here, so why? Right? Burning $760,000 net income per employee TTM. This is not sustainable. This automatically makes it a spec stock. Extremely speculative. Qualitative analysis only at this point, right? So let's look at ALGS here and see what's going on with the revenue. Just get a quick snapshot of the financials. You can look at balance sheets on here too and stuff. Okay, so they're bringing in $311,000 last quarter, negative 68% growth. Okay, you don't want negative growth ever. But let's just say, for $311,000, and we do that over 4 quarters as an average. What did we get last time? Well, 629, 1 point. So this is a what happened here? You went from 986 to 1 million to 1.27, and then lost 50%. And then another big 68% loss here. What is going on? I don't know. This is what you have to dig into. Growth is negative 32%. Big red flag. Big no. No, I can't touch that. Nope. Can't touch it. MC Hammer. Can't touch this. Valuation. Okay. Price to sales forward is a 24. All right. In the .com bubble, if you saw something like 10 price to sales, it was absolutely outrageous. And now we see things like 500 price of sales and 5,000. Oh, 24 is not bad. It's bad. It's bad. And this is completely speculative. It could make you a ton of money or lose a ton of money. It's kind of a roll of dice. And it's basically a penny stock. Even though it's trading at $7, it's essentially a penny stock. And penny stocks do huge volatile moves like this. Of course, this is a drop here when the revenue, when the earnings missed here by 42%, what have you. Your guess is as good as mine on biotech, man. If you invest in a lot of biotech, you can make a lot of money, but man, you can lose your shorts. And for me, I understand other areas better, and I just stick to what I know. Do what's best for you. And will AI disrupt Dua Lipa, or will she benefit? That was when it was 251. It's doubled since then. So I guess Duolingo is benefiting from AI and not getting eaten alive. You could have easily made the argument either way. AI is going to take over, or AI is going to benefit. And this is going to be for a lot of companies. They're either going to adapt and pivot into AI, or they're going to let AI eat their lunch. So for the Fibonacci range here, 288 to 601, 287.93 to 601.34. So I'm just rounding. The growth is there. The valuation still a little nosebleed. Now, I would much rather, right, if you're looking at something, I would much rather have you take a flyer on something like this than the last stock we looked at. And, that stock could triple overnight. And you say, Eric's an idiot. He said, not to buy biotech, and I made 300%. That guy's a loser. Well, I mean, anything can happen, right? all I can say is this, and I hate to pick on her, but I got to, right? And hey, over the last 5 years, down 8%. I can tell you, I'm very, very green over the last 5 years, not down 8%. So maybe I'm not such a bad stock picker after all. Am I wrong sometimes? Sure. Could I be wrong about something I say on chart day? Yeah. I mean, but it's all about a numbers game. It's about, again, those guardrails so you don't fly off the damn cliff. That's what being an investor is all about, is managing risk, taking calculated risks. Right? That last company is not a calculated risk. It's just a complete YOLO degen flyer gamble. And you can make money on those. And I buy them sometimes myself. I mean, Rocket Lab would have fit in that category, and it ended up being the 10X, thanks to lots of due diligence from the community, especially Derek. That was a great winner for us. But look at like a Palantir, look at a lot of these names that probably don't deserve to be at the levels they're trading at, but the market does what the market does. But look at Duolingo. I like it because you got this higher, software type margins at 72%. The first profitable company maybe we've looked at, it seems like they're bringing in $116,000 net income per employee. You want to see that, high quality. It's okay to have a little bit of spec, but understand the difference between growth and spec. There was this conversation in the individual stock discussion yesterday, and I'm not trying to pick on anybody specific, but there were a bunch of meme stocks listed, and Matt asked a question, and it's not just, there was a couple people on here, and you can categorize stocks however you want. If you want to call a spec stock a growth stock, you do whatever the hell you want with your portfolio. But I have noticed that, and this happened in 2021 as well, some of our community members, you start to kind of drift off the road a little bit, and you're kind of grinding against the guardrails. Just be really careful with some of those meme stocks. I'm not saying you can't buy them. I'm not, do whatever the hell you want with your money. But my job as the community leader is to show things when I see it and remind you that, hey, make sure you focus on quality. If you're buying these really speculative names that are burning cash, I just showed you a stock earlier that has zero revenue, right? Be really careful with stuff like that, especially in a market like this. This is where you get hurt. There will be rug pulls, and SPACs are back. IPOs are back. In fact, just yesterday, they announced another IPO coming out for Figma. You guys see that? I try to keep you up to date in the IPO channel, but Figma files for a New York Stock Exchange debut. Tech IPO, so design software firm Figma. Revenue rose 46%, blah, blah, blah. You can read it in the IPO channel. All right. Cool beans. Let's go back to whatever the hell I was talking about. How you guys doing? I've got a lot of energy this morning, fired up a little bit. But Duolingo, so it's got, it's 33% growth. I like this. I want to see A+ growth, 39%. These are solid numbers. Now, don't just look at this and say, oh, it's got good growth, I'm going to go buy it. No, really research the company. Understand the competition. Competitors, according to Seeking Alpha, Rosetta Stone, they used to be the shit, not publicly traded, and they've really fallen off. Babbel and these other companies. This one seems like it's the younger generations are really clinging on to Duolingo, Dua Lipa. Short interest, 4%, $18 billion market cap. It's not cheap. This is what I want to show you primarily. So 134 GAAP P ratio. Of course, one of the best companies in the world is NVIDIA. It's trading at 37. So is Duolingo worth 4 times more than NVIDIA? I don't know. That's your up for you to decide. NVIDIA is actually growing more than Duolingo. Look at growth here, 60% forward revenue growth versus what we say 35 or something. 33, so do whatever you want with your money, but I can think of a lot of better names that have more growth that are cheaper. I like the fact that that it has some profitability metrics. It has a PE ratio, but it's very expensive. Price of sales is still a 20 for the 18.37 for forward, 22 for the current price of sales. From a technical level, it's pulled back. It's pulled back from 540. It's now below the 100. This is the S1 here, around 382. The 200-day moving average is around 361, and this S2 is 347. S3 here is 287. So you could see it kind of pull back, maybe somewhere where it's at to maybe the 200-day moving average, maybe a little lower, this S2. If things get really bad, of course, you could see it come down the S3, and of course, it can always go lower as well, right? So it has pulled back. Is it cheap? No. Was it an air pocket? Yeah. I mean, this isn't going to be a perfect chart, but just, quick glance in it. This is an air pocket, so you don't want to buy it. And if you were to come back to this red trend, you'd be somewhere around 330, which is, probably lower than you're going to see it unless something catastrophic happens. Roblox is the next one. The only reason that you should be looking at this, in my opinion, is if you're trimming it, because I like the stock when it was $35 or whatever. I trimmed at 100 and it got all the way up to, of course, like 106. And it always does that. You sell at 100, goes to 106. Oh, well, I mean, high quality problems when you're winning too much. Oh no, I could have been up 105%, but I sold it 100% or whatever, and I trimmed it out. I did trim it out of the main just because it doesn't fit the risk profile we do own in the community portfolio. It could consolidate, and in a bull market, it probably goes to $120, but not something I want to buy at $100 myself. If you really love it and it fits your risk profile and all that, great. This is one of those names, you get into a recession, it's going to get hammered. It might go to $150 and then be back to $100 2-3 years later. I mean, seriously, it could happen. So there, for me, I can't buy a parabolic move from 50 to 100. It's impossible for me to be okay paying 100% premium from, a 3-month bounce. It's just not me. It's not in my DNA. I can't do it. And if I'm wrong, I'm wrong. If it's a must-own stock, I miss it. If it pulls back, I buy it. This is a fringe play. It's not going to be a core play. You're not going to buy it after 100% rip. KTOS, Kratos Defense, air pocket. You can see the red trend line here. And we got an air pocket, got up to $46. It's now back to 42. It's still way above all the moving averages, though. This 50-day is 37.90. The 200-day down here at 30. After it consolidates, it probably goes up here to 50, $53 in the R3. And just, understand what it is, what it does. Does it fit your risk profile? All those different things. It's going to pay you probably a little dividend. Nope, it doesn't. Okay. I haven't looked at this one for a long, long time. Profitability at D, pretty low margins, growth. 13% is not bad. 273 4P ratio. That doesn't make any sense to me. So I'd have to dig into it, but those are the technicals. IQV. Okay, so brutal chart here. This thing absolutely just got hammered like a lot of these. And this is tough, right? You bought this in 2021 at 285, and 5 years later, you're still down 50%. That's brutal. It's tough. But you don't want to use anchoring bias and say, oh, this is a $300 stock. Like I said in the beginning, now it's 165, so it's garbage. Maybe it is, maybe it isn't. You can't just look at a chart and make that decision. And we have to do our best to try to eliminate those biases and be neutral. It's very hard to do, but we have to try to be robotic. So what happened? That's the main question. Remember, fundamentals are 99% of what we do. The technicals are 1%. So the chart's not going to tell me what's going on here. That's going to be your research, your due diligence, both the fundamental, the quantitative and the qualitative. This fib range is 125 to 180. It's a Chinese stock. Just be really careful with these. Target. TGT. So this is at 104. It looks like it's holding up pretty well. It's behaving bullishly. Actually, it was down to $87 in April. This is one that we were buying, of course, under 100, and it goes lower than you think it would. I thought maybe it'd go to 90, 95. It got to 87, and that's okay. I'm up maybe 10% or something on target now. 7%, 10%, something like that. Nice pop and and gently back. Nice pop back to 103. Up 5% yesterday on Tuesday. $94 support right now. With that 94 support, I would look for 110 to 112. Remember what this is, though. This is a dividend king. Has 52 years of dividend growth, a 4.62% dividend. I've been buying this in the dividend portfolio, covered it a couple times on YouTube, and said it was a buy under $100 a share. It might not fit your blueprint, though, right? What is this? It's a DGI name, obviously, because it's a dividend king. So first and foremost, it's DGI. And it really starts to get into the income category because of the high yield, because the stock is down. So this is a DGI type income tweener. It's got a 54% payout ratio, which is still under that danger zone, right? So the dividend's pretty safe, A minus. The growth is going to be negative. They have an F growth, and that's why it's priced the way it's priced. So what the market's doing now is they're looking and saying, hey, we've made a lot of money on growth and in these mega cap tech names, Magnificent Seven names, AI trade. Now let's take a breather on that and let's kind of rotate some of that money back into the beat up stocks, maybe value stocks, things that pay dividends, And really the market's trying to find some breath to say, hey, let's really expand this bull rally, not just from the AI trade and a handful of names, but everything benefiting. And that's why, again, investing against the grain, buying those dividend stocks when everybody else is chasing growth. And we already own those growth names because we were buying them before they were. And that allows you to then use that capital to buy against the grain. So I'll keep buying dividend stocks while they're, beat up like these. I don't think it's going to go to 150 again anytime soon. And then when growth takes a breather, I load up again on growth. I loaded up in 2022. I loaded up, 2023, we had a sell-off in the fall, loaded up there. Loaded up again in August of 2024. Loaded up again here in April. And it's a cycle. You buy at the right times. You're not going to be perfect, but you try to buy when things are on sale. Then you trim off some profits and raise some cash and rinse and repeat. But I think that this bull market could last. It could go much higher. I mean, some people think it can go another 2-3 years during the rest of this term. If you get this tax cut, it's going to increase the deficit, but short term, it's going to be a tailwind. You get some interest rate cuts behind that, and you could see the market go to 6,500, 7,000 this year, early next year. But that's what's going on with Target. OKTA, like octopus. I don't like this company. I'm not a fan. I've told you many reasons why. It doesn't mean you can't buy it. Do your homework, though. Make sure you understand it. It's a tough segment with identity management and cybersecurity. Lots of competition. It's the first line of defense. It's very difficult. And it has, even like CrowdStrike and more companies are starting to do their own identity solutions. So this is something that I don't feel, I have a hard time sleeping at night if I own $100,000 of this stock. That's just me or whatever, right? The fib range on this is 89 to 112. It is behaving somewhat bearishly. You can see it's probably a 60% sell to buy ratio in this here. 200-day moving average is 93. I think if you are buying it, I would want it to come down, somewhere in here, but it might not happen. But that's where I'd kind of target it. For me, I wouldn't buy it, really at any price. Even when it was back here at $70 in November, I had zero interest. And you could say, oh, you had zero interest and went from 70 to 127. That's not how I buy. I buy, I think, in 2, 3, 4, 5 years, long-term investing, high quality companies, best of breed. This would be best of breed for identity. I just don't think it's necessarily something I want to have as part of my blueprint. That's just me. You got to do what's best for you. RIVN. This is spec only. So this is spec. This is one of those you can make a lot of money, but you can lose a lot of money. Boy, they got the replay on. Let's turn that off. There we go. All right. So RIVN, let's just look at the quick fundamentals on here. So profitability, it's an F. It's burning cash. It's, negative 258,000 per employee. So automatically, what? Answer. It's spec, right? Excuse me. Sorry. But it's spec because it's not profitable. That basically makes it spec every time. Growth, 18%, but this isn't crushing it by any means. Price to sales, 2.95. Well, this is a hell of a lot better than 20. So could you buy some RIVN at $10 to $13 as a spec? Sure. You'll probably lose money. Automotive is one of the hardest things, and EV is not going to be any different. Look at Ford and GM, how much they've struggled. A pure play automotive play, even if it's an EV pure play, it's not a good investment in my opinion. Do we own some in the community portfolio? Yeah, it's less than 1%. But I just really think about what cars are, how hard they are, the margin profile. The only reason that Tesla does what it does because it's a cold stock, and the reason I have more confidence in Tesla is because of the robo-taxi and potential moonshots like Optimus. RIVN doesn't have any of that. It's just, hey, we make trucks, right? And and there's other things. They've got some partnerships and stuff, but this has negative gross profit margin. So to my point, right? These companies struggle. These car manufacturers. Manufacturing is very competitive. There's lots of people that are doing it, and the margins are razor thin, and it's very, very difficult to be successful. Tesla has the best margin in the business, and it's still not very good at 17.6%. You look at a SaaS company, beautiful recurring revenue, 75% or higher for a gross profit margin. Understand what you're buying. Grocery stores are going to have different margins than software as a service. You're going to pay a premium for that recurring revenue and those margins. ACMR, E the man looking to sell. Now, this does have some Chinese risk to it, but it is a California-based company, and they really do most of their business as a subsidiary in China. I think that most people doing business with ACMR in China don't even realize that it's a US company. So if you are going to own a Chinese company, this is the Chinese company, in my opinion, to own, because it's actually a US company, right? It's based in California. The R3 is 29.69 up here. Okay, the previous all-time high, I think, is 30.64, unless there was a high back here somewhere, but the recent high, at least, I think it could break 30 in a bull. Yeah, it was higher back here, 34, all the way up here, 39, 48. Pandemic, right? YOLO degen gambling. This is what happens, guys. We're getting that market. Like, if you look at where we're at right now, we're probably, somewhere here. Not specific to ACMR. Let's just pretend, though, we're going back to 2020. We're at $31 here, and it goes to this bull off top to 48, right? So anything you bought in here, this is really bad if you bought up here, but anything in here that you bought, it was frothy. So I'm saying that right now in 2025, we're kind of at this level down here at 31, and the thing could go to 48, and it only was there for a brief amount of time. So, really it's probably something like 40, if you look at the baseline, so 30 to 40. And you say, hey, this is a great buy. I love this company. It's 2021. I'm going to be rich in 3 years. I'm going to retire. I'm going to, buy a yacht and sail the world, because the stock market, it's just printing money, and I'm going to get rich overnight. Okay. So you accumulated heavy $30 to $40. You're going to be a millionaire. Okay. Well, now it's $5.46. Oh shit. Now you sold, right? You took your ball and you went home. Boo-hoo. Wall Street sucks. It's not my fault. It's the people in the suits. They're there to take my money. Well, it's because you don't know what you're doing, and you let them take your money, because that's what they want to do. Just don't let them, right? Stay in our community. We'll teach you how to not lose your money to the suits in Wall Street, because it does exist. The wolves of Wall Street do exist, right? Okay, so now this is when you buy. Now you don't have the anchoring bias to say, hey, it was $35. It's trash. So we bought it, not at $5, unfortunately, but somewhere in here, we bought. So towards the bottom spectrum. And now guess what? Now we're back in that same range. Let's just draw this fun little line here. I feel like that Ross Painter dude. Okay, we're not quite there, right? We're not quite there. So let's just say we bought all this, we accumulated ACMR. And the thing about this is it actually is a profitable company. It has decent metrics. This isn't even a meme stock. It's not. It has pretty solid fundamentals. Okay, so you accumulated all these shares in here. Okay, so you bought all these shares up in here, right? So 5 years later, you're still down because the stock is $26. And you think, oh, this company sucks. Well, no, you just bought it the wrong time. So, now you want to sell, which is fine. Just understand that, it can go to this red line all the way up to this red line. This is the all-time, actually is even higher than that. It's up here. I don't think it's going to go to $48 anytime soon, but just to give you some perspective, this is 2021 up here. Basically this line to this line, this is the middle line. Right now, you're looking at S2 to S, or the R2 to R3. So it's probably going to go somewhere close to $30. That previous all-time high was March, not all-time high, but the previous high was $30.64. So I think that you could get in this first circle if it stays bullish, and there's no bad news in China. Bad news in China, sell off, went from 30 to 16, lost 50% overnight. So there's always that risk. The next circle will be here, and then so on. And I think it's possible you get, up to 35, which would be this next level. If you're selling, if you lost conviction, just sell the damn thing. But if you're looking to try to time it a little bit, maybe put it in at $29.47. If it goes to 32, who cares? It doesn't matter. That's one thing, guys. Make sure you remember this. If you're putting sell orders in on something like that, you can't look at it every day and go, oh, I sold, on Tuesday, I sold the stock at 50. I'm going to go look and see what it's at today. Oh, damn it. It's at 53 today. Oh, I would have waited for those $3. Don't do that. I mean, some of you guys have huge portfolios, but the majority of it in the community don't, right? So you're talking about 5 shares and 10 shares, $30, $60. do not split hairs over shit like that. It'll drive you bonkers because you're never, ever going to time the bottom perfectly or the top perfectly or trims. It's just not going to happen. Don't even try. Don't try. All right. So that's ACMR. Yellow circle, probably just sell it in here. Maybe even now if you just want to dump it, and here's the possibilities. Palantir, currently trimming. Well, yeah, I hope no one's buying it here. Unless you go on YouTube, they tell you, buy it hand over fist at $150. But so Palantir, I said on YouTube last week it'd break 150, and it got to $148.22. I do that a lot. I missed it by $1 and whatever the hell, 70 some cents. It broke down from there, didn't quite hit 150. That happens, right? The S2 is 152 or is 152.59. S3 is 163.77. So new S3 all the way up here, guys, 163.77. Now Jim Cramer thinks that Palantir will be $200 later this year. He says, give it a couple days and buy it on Monday. And with retail, the way retail is, it probably will buy it on Monday, and it probably goes to 150 next week after we have 4th of July and everybody gets together and says, oh, Palantir, they're protecting us from the world right now. Oh, all this stuff that Palantir doesn't do that retail thinks that it does. If you want to get excited, you want cheerleading, just go type Palantir on YouTube, and there are tons of channels that can give you all kinds of excitement. Like, you're going to get rich on Palantir if you buy it $130 a share. No, we bought it at 9 and 10. We bought it at 20. We bought it back here. This is how you get rich, buying before the masses, not this. And you can try to justify the valuation all you want, but an 80 EV/NCM revenue, it doesn't end well ever. Snowflake was 100 in 2021. You know how that worked out. It lost like 70% of its value from that peak. I'm not saying that's going to happen with Palantir anytime soon. I'm telling you, it's going to go higher. It's going to break 150, probably 163. And hell, I wouldn't be surprised to see it at $200 because retail is just crazy excited about the company. I'll trim some at 150. I'll trim a little more at 200. It wants to go to 250. I'll trim a little more. I don't mind making money. I like the company. It's expensive. It is just, it's a retail cult stock, and it's fine. I'm just glad we bought it when we did. And we were the first YouTube channel to cover it 6 months before it went public. And, it's been a great winner, but I'm not going to buy it at $130. It's just not me. OKLO, $8.86 right now. I think she's headed to 10 plus after consolidation, but it's OKLO, and it could literally just drop down to $5 next week. So there's not a lot of, I guess, institutional support, retail support. Retail doesn't even know it exists. I mean, it has paper hands across the board, and it's going to be volatile. I think it could break 10, but honestly, it's not something I'd probably go around and buy. You're probably looking at getting out of it. I know I'm red on it as well. And I like Noah. He's, I think he's a good guy and seems like he does a good job as CEO. And I think the company could do well longer term, but it's just, it's been a dog, and it comes down to, I bought it at the wrong time. If you look at the growth, it's actually pretty good. 20%. The profitability isn't as high as you'd like to see it on SaaS at 54, but it is profitable with net income per employee. Valuation wise, it's going to be expensive because that recurring revenue, it doesn't have the GAAP 4P ratio, just became profitable actually. So these numbers aren't terrible. Price to sales, 4. It is kind of just what it is. It's a $1.48 billion market cap. Interesting company, spec, not something I would buy at this point, knowing what I know now. One of my mistakes, and I do make mistakes. BYDDY. This is OTC China. This is BYD. Fib range 82.89 to 115.41. $75 support. I'd say you see 85 plus, but of course the market's breaking down right now, and it could come down to maybe the 200-day moving average or something. Probably find support where it's at around 92, if not maybe 89. And these are kind of your possibilities. Be careful with Chinese stocks again, and especially OTC. Do what you want with your money. But if it does go to the upside, it's going to have to pass, get past $100 resistance, and then 109, then 120. So it has a wall of worry to cover. Not something I'm buying personally, but this is Clearwater Analytics. It's kind of funny. Yeah, and I laughed at it. No disrespect, but it's kind of like, I don't think anybody knew this company until I mentioned it. I don't own it. It is on the watch list. $20 or less DCA. It might not get there. S3 is 1873, finding some buyers around 21. The R3 is 26. I'm still doing research. It looks really interesting. It's a little bit complicated with the recent acquisitions. So I think if it gets under 20, I'll buy it as a flyer. I'm going to continue to research it in the meantime. And it is getting close, 20 and 57. And it probably doesn't get to 20 because that's, generally what happens. Next Tracker is another one. I was researching and I was going to buy this. And it was literally down here like $42 and now it's 61 and it's probably going to go higher, like could go to 75. So yeah, again, I'm disciplined. I have a certain process that I do. I spend a lot of time before I buy a stock researching. Sometimes you miss it. And in a bull market, everything is going higher. It doesn't necessarily mean that you're wrong because zoom out 3 years, you don't know what it looks like. In 2021, you could have felt like you were wrong all the time. But then in 2022, you felt really smart if you missed a lot of those. So don't let the FOMO get to you. At the end, this is a marathon, not a sprint. And there is no get rich quick in the market. So don't stress out too much. You're going to get there, especially, there'll be more opportunities in the future and you're in the right place. Arista Networks, this did break down from news, fundamentals, competition. So this is not a technical breakdown. This was more of a fundamental breakdown. Understand that fundamentals are going to drive technicals. Technicals can only do so much. The macroeconomics, the fundamentals of the business, the headlines from the business will impact buying and selling by traders, and it will impact the technicals. So the technicals broke down from fundamentals. I do think that traders have short memories and they're starting to buy again. And you probably see similar levels. We had 106 to 116. Now it looks like 101 to 114, these new R1 to R3. This one should be watched closely. Based on some of the information I'm seeing, they are losing some of their competitive advantage, some of their moat. Not that there was ever a true moat, but their moat-like qualities. And it does have me a little bit concerned. It's not one that has ever been like super high conviction pound the table. It's one I added as a new position in April. It does have good profitability margin, which shows it does have pricing power, strong net income per employee. I'm not selling it. I'm just saying it's something we need to watch. It's got good growth. It's expensive. 40.68 forward gap PE ratio. None of these are cheap, right? So I still own it. I think it's going to go higher, but I do think it's one that we have to watch carefully, do some more homework on, just really keep an eye on as a team. Ozzy Pete, player of the week. Congrats. Dynatrace, Fibonacci range is 51 to 59. I prefer Datadog. So right now you can see, you're kind of consolidating, finding some buyers today at 54. Upside probably 58, previous high 63. I would look at Datadog. Market just turned green. Not surprising. The market wants to go higher. Nothing's going to hold it down, it seems like, right? So market is green. Well, S&P is slightly green. Tech back in the, we had a 1 day kind of swap from growth to dividends, and now we're already back to growth. It's, we're probably going to go higher. It's going to take quite a bit, I think, for the market to break down. Could it break down? Sure. And there are tons of risks. We have this tax bill legislation. We've got July 9th is the deadline for tariffs, although Trump's kind of said it's a loose deadline, but there are a ton of risks that are still out there. But right now, the market wants to go higher. When things are bearish, the market's going to go lower than you can ever imagine. When things are bullish, it can go much higher than you can ever imagine. Expectation right now is the market's going to keep climbing higher. So just be careful if you're young, just, trying to trim out of too many stocks. Remember, I'm trimming to cash on some of this. Someone asked me yesterday. Boom goes to dynamite. We used to work at Oracle together. He works for Datadog. Boom asks, hey, why are you selling these? Are you just selling them to get to your blueprint allocation? Well, that's part of it. But I put out that video, 12 stocks that I've targeted to buy or sell. I'm selling those because I am cleaning up the portfolio. I'm lowering the beta, but I'm starting that end game metamorphosis. And I can't do it overnight because I have like $1.6 million in tax ramifications if I liquidate the whole thing. So I have to slowly trim stuff over a period of years to lower the tax burden and then slowly convert that into dividends. So you'll probably see over the next several years, $1 million or so funnel from the main into the dividend portfolio. The hope is that it grows enough where it's still going to be relatively the same size and it's going to be kind of a gradual process. What I'll start doing in the future is I'll start sharing the total portfolio value and then the 3 individual portfolios. When we do portfolio updates, we'll do performance, the way we've done it with each one separate. but we're going to start using the total number of those three portfolios kind of together. And you really could do it that way. You could have it as one account, but I'm trying to keep them separate so that depending on where you are in that life cycle from accumulation to preservation, there's a portfolio that fits your needs best. And you can kind of track that one the closest, but still learn, if you're in the accumulation phase, you can still learn from the dividend portfolio and learn how that process is going to work. Cause I'm kind of still learning myself. I've never metamorphosized millions of dollars into passive income. So it's a work in progress. I think it's a really interesting case study and real life case study to see how this works. And you're coming along for the ride, with me on the journey, which I think is great. Two more stocks. SN is the next one. I like this Shark Ninja. It's kind of a cool company. It was a IPO back in August 2023. There weren't a lot of IPOs back in 23, but this was one, and it's done pretty well. $33 here, all the way up to 123. So you could have made some good money, and people were pretty gun shy. I remember even looking at this saying, man, I like this, but I'm not touching an IPO after what just happened in 2021. Well, anchoring bias got me. That's kind of the message of the day. I like this stock. I like this company. I think it's kind of cool, but it's not something I'd probably ever buy. Honestly, it just doesn't fit the blueprint. The profitability is higher than I would expect on the gross profit margin. Growth, it keeps growing. They keep making, and I've got an air fryer and a blender and a bunch of stuff from Shark Ninja. It's a cool company, price to sales forward 2.23. So, it's not cheap, but it's not insanely overvalued either. Would love to see it, in this $50 to $60 range would be ideal, but it was $60 in April. That's long gone now at 100. It's probably going to go higher. The R3 is 112, previous high 123. If earnings continue to do well, could easily see this 100 plus, maybe even 150 with time. Interesting one. Glad you brought that to us. It's always fun to see some of those newer IPOs, and it does fit the 18-month guideline. So thank you. Confluent. Excuse me. I've liked this company for years. And here's the thing, man. I'm always honest with you guys. I'm very transparent, probably to a fault. Wear my heart on a sleeve. I've liked this company. The community has been bullish in this company. It's been wrong. It hasn't made me money. In fact, in the main, I'm down on it. We are green on it in the community portfolio because sometimes we learn lessons the hard way from the main portfolio and then benefit from the community portfolio with some of the cost basis and things. But this has been a laggard, and this was all the way up here in the pandemic. I didn't buy it up here at 95, but when it dropped 50%, I started buying it, in these levels, and we're still not back to those levels. We were here in February, and I woulda, coulda, shoulda even thought about selling out of it at that point. I like it, but at $40, I'm like, hey, maybe I should sell it. And then of course it drops from 38 to 18. I'm down like 45% on this in the main. It's the biggest loser in the main, actually. The only positive, not that I'm going for this when I buy a stock, is that I have a ton of tax burden this year, and we'll have even more as I trim more. And selling this, if it's down 15,000, like in the red, I have over $100,000 of long-term capital gains I can offset. And it helps with some of that tax burden. So. It's not all loss, which is why I like to buy individual stocks, which is like why I like to buy why I buy, because you argue me wrong sometimes, and you can kind of just clean, wipe the slate clean. It's part of the process. You want to be right every time, but you're not going to be right every time. You're going to be wrong sometimes. This is one I've been wrong on it. I still like it. When it gets under 20, I think it's a buy. It's very much kind of a trader stock where it goes, 20 to 40 and kind of pops around. The upside is 27. This is a name, though. It misses earnings and it sells off 35%. Right now it's bullish. It's probably going to go to 27, maybe even 30. And then you're going to have earnings end of July on 30th. And then who knows? It could pop. The thing about this, too, is it doesn't usually pop 30% up. It'll either be down 30% or maybe up 10%. So the upside is on a daily move, maybe 10% on the upside and 30%, 40% on the downside. So it's range bound. It has been since 2022, really. $16 down in here up to 38. If you look at this, I mean, it's been that 16 kind of floor and been to 41, back to 16, 35, back to 16, 34, back to 18. So a little bit higher here, 17 and 18. You can see the floor went from 14 to 17 to 18. Will it break out or continue to lag? So far, it's been a laggard. All right. So to kind of wrap it up, guys, I went through and did some real talk as we kind of covered the video and in the stocks. But I think anchoring bias is a really good message for us, a reminder to us and to myself that, if I am investing for the long term, if I'm 25, I have to be really careful of like, oh, I didn't get a perfect price in April. Think about if you're buying high quality companies, and that's the key, high quality companies. You could have bought Amazon or Microsoft anytime, at any time, and made money. Let me just pull up a chart so I can show you. So Microsoft, I mean, of course, nobody I know bought it at 10 cents as they did. They're probably on a yacht somewhere back in 86. But basically, anytime since it went public in 86, you could have bought it any time. It's at all-time highs. And just recently, this stock was down, to what, 350 or something. We were buying it in the dividend portfolio. Now it's back to $500 a share. Awesome. Awesome. And this is one of my top high conviction stocks. It's number 2 on that list behind Amazon. If you've watched that on Patreon, you could have bought the stock anytime and you made money. And so it was too expensive at 242. It was too expensive at 280, 300, 400, and so on. Amazon, another one. And again, remember, high quality businesses, not every company is going to be this way. And people try to skew stats and say, oh, if I buy, this meme stock, it doesn't matter if I'm overpaying it and it's 50 price of sales because it's going to be the next Amazon and the chart's going to look like this. Well, probably not. Now, technically, Amazon's not at all-time highs. That was 242. So if you would have bought the very top, you're still down $20. But basically, since 1997, when it went on the market for 9 cents a share, again, if you bought it, you're probably on a yacht somewhere, not listening to me. But in 1997, at 9 cents a share, if you bought it any time, you made money. Now, you had to be really patient because you could have bought it at $2.07 in 2000, and it got down to 50 cents or something, 55 cents in 2022. So you're down like 75%, and you probably sell it and take your ball and go home. And now you look back and say, if I wouldn't have sold Amazon at $2, I would be a multimillionaire. Well, you got to pick the right stocks. That's always the tricky part. But the point is if it's a high quality company, it's probably, if you have a 20-year horizon, there's a good chance you're going to make money over those 20 years. Now, it's a slippery slope because you can just basically use that as an excuse. Our brains, we can use anything to justify whatever we want to justify. Like, oh, well, I shouldn't buy a $100,000 SUV or a new Tesla Cybertruck because it's $100,000. But I work really hard. I got a bonus last year and I need it. I have to drive to work every day and to back and forth. And that luxury, having self-driving and all that, it's worth it. So I'm going to pay, $100,000 and you just justified it. Well, there are other ways you could do that, right? You could still buy a Tesla and buy a cheaper model, and you could buy a used, whatever. You get the idea. Tesla kind of dictates that a little bit, but you get the idea. You could look at competition. You could look at XYZ, or hey, this t-shirt's $100. Looks really good on me, and Kanye West designed it, so I'm going to pay $100 for a t-shirt, even though it's worth $3. And you can justify it because you're going to be the coolest kid on the block if you wear the shirt, and all the chicks are going to dig you, right? That's how we justified things when we were in high school. So you can justify and say, oh, this meme stock is, 500 price of sales, and I missed it when it was on sale. Palantir, I missed it, but I'm going to buy it at 130. It's going to go 200. You probably will. It'd probably make money. But you can justify that for anything. You could literally take a penny stock worth 30 cents and say, I'm going to buy this stock because it's cheap and I'm going to make a bunch of money and I'm going to justify it. So just be really careful with the anchoring bias, though, of a high quality business saying, I'm not going to buy it because, it's not on sale. And it's a slippery slope because Palantir, you could make the argument, well, in 20 years, it's going to be worth $10 zillion. So $130 is cheap. And that's what you're going to hear on YouTube. Right. But there's a fine line too, where you're simply overpaying and you're using that justification method just to convince yourself that what you're doing is okay, when really it's not. And again, for fundamentals, when you think of Fired Up Wealth and the methodology, it's principles and guidelines, guardrails, so you don't fly off the cliff. You don't drive off the side of the mountain. when you remove those guardrails and say, screw having any sort of discipline and methodology, I'm just going to follow my gut and just buy stuff because my friends tell me at 4th of July to buy it, or I saw an X post or whatever. And you justify it by saying, I'm a long-term investor. Well, people did that in 2021 with a lot of garbage companies that are still down 80%. And if it's a good company, most of those good companies are actually worth more now than they were in the pandemic. Like an Amazon or Microsoft or something like that. But if you bought like a Teladoc, it's down 95% in the past 5 years. So you could have bought this at 293, which should be down 99%. You could have bought it at 293 and said, it's expensive, but this is the future. In 10 years, it's going to be worth a lot more money. Well, actually, you're going to lose all your money. Again, high quality. This was spec. Now the guardrails are there to say, hey, this is spec. So if you're buying it, it's a 10X or 0, right? So you're going to buy 1% of your portfolio here, not go 10% weight. And if it does this, well, it hurts, but it's only 1% and you've mitigated some of that risk. Now, some people will tell you, well, if you want to outperform, you have to have a concentrated portfolio. Well, first of all, Berkshire Hathaway doesn't have a concentrated portfolio. I've told you this many times. They've got, 200 different holdings. If you take the private companies, the Dairy Queens and the Geicos, their highest weight is Apple at like 8%. So it's pretty much in line with what Fired Up Wealth Blueprint does. In fact, more holdings than we do. We usually do 50. Peter Lynch outperformed the market with 1,000, 2,000 stocks in the Magellan Fund. And that goes back to modern portfolio theory. But people try to use like Buffett analogies, and then they go out and buy meme stocks in 2021, like Teladoc, and say, oh, well, Buffett does this way and he does concentration. So I'm going to put 40% of my portfolio in Teladoc at $290 because I'm the next Warren Buffett. And this is what happens. Make sense? But there are a lot of these, right? There are a lot of these companies that I've been seeing. This one, for example. First of all, insurance companies in general are not investable for me. Really do some research if you're interested in this company. My wife works in the insurtech space. I guarantee you I know this company better than anybody else that you know. Not anybody else in the world, but anybody else that's watching this or that owns the stock or any of your friends. I guarantee I know this business better than you. And I'm telling you, do your homework on this. But nonetheless, you're still down 37%. And that's at this price at 69. You could have actually bought it at 163 and be down a lot more. But again, you justify and say, oh, well, this is a high quality business and I'm going to own it for 20 years. Upstart's another great example. Oh, it's expensive at $300 a share, but I'm going to go ahead and buy it because, it's $342 a share, but I'm going to buy this, put 10% of my portfolio because it's, in 5 or 10 years, it'll be worth a lot more. Well, actually in 5 years, it's not worth a lot more. It is from back here in 2020 at 40, it's up 64%. But if you bought the top at $390 a share, well, you're down a lot at $72 a share. You get my drift. So what you buy matters. I always say this, what you buy matters, but when you buy is also very important. And remember how much that psychology really ties into investing, and really everything that you do every day in your life, psychology is all around you. But if you want to be a good investor, you want to be a better employee, you want to be a better husband, a better father, whatever you're trying to strive to be, psychology can help you in so many ways. I'm not saying you have to go out and get a PhD in psychology, but at least have awareness about what anchoring bias is and how your brain is wired, how your brain works when you go to shop to buy something. Next time you see something on sale that's priced at $1,000 on sale for $300, try to think back and remember when Eric talked about anchoring biases, right? And this is just one example of hundreds of different things that your brain automatically does. In advertisers and the internet, they're there constantly flashing this stuff in front of you. If you're on Facebook, advertising, even X now advertising, you're watching a YouTube video, advertising pop up. Everything that you see, people are trying to feed off your emotion. If you want to be a good YouTuber and you go through YouTube coaching and training, or you pay for AI services, they're going to show you how to make emotional and dramatic thumbnails, how to make titles that are especially dramatic and emotional to feed off your emotions. Like, do this now before you regret it, or the stock market's going to collapse 30%. and have this thumbnail. Those are there to feed off of your emotions, especially fear and panic. Your body has an automatic sensory alert when it sees something like that, and basically it wants you want to click on it. Everything that you on the internet, it's there to get you to your eyes to something, your views, your clicks, because there's advertising dollars, or to get you to buy something, or to upgrade something, or to what have you. If you understand how this works, it ties into sales so much, but it really helps you understand that I don't have to have $100,000 car, and I don't have to have designer clothes. And yeah, I can afford a $3 million house, but I'm okay with my $500,000 house. And I'm okay driving a 2018 Honda CRV with 100,000 miles, because I don't need another car, and that's really a psychological mindset, because if you have the wrong mindset, you say, well, I have to have those things to feel like I'm successful. And trust me, I've gone through this myself. When I was in my 20s, I spent all my money because I thought, hey, I finally made it. I'm the first person in my family to go to college, and I'm making good money, and I'm going to go out and buy, the luxury SUV, and I'm going to go buy the sports car, and I'm going to go buy the fancy car, house, and I'm going to do this and that, and I'm going to show off to my friends, and I'm going to try to keep up with the Joneses. And if my neighbor buys something, I'm going to buy something bigger. I played that game luckily in my 20s, and by age 30, I'd figured out this is a dead end. This is part of the rat race. And I do give, Robert Kiyosaki a lot of credit, because Rich Dad Poor Dad, even though he's kind of a nut job now, in my opinion, his older stuff is really good. And that really helped me understand what's called the rat race, the mousetrap. And sitting in my car every day, stop and go traffic for 30 minutes each way, and then reading books like that and listening to, to Rich Dad Poor Dad and audiobooks and things, made me realize, okay, well, I got to do something different. And so I thought real estate was the answer. I did real estate. I had 12 rentals and decided that wasn't it either. Stock market was something I was really into. And it's the easiest wealth creation tool of all time, of that mankind has ever created. And anybody can do it. It's super simple. Your tenants don't call you at 4 o'clock in the morning and say, my toilet doesn't flush. It's as passive as income as you can get if you have dividends that are passive income, right? So hopefully you guys benefited from this session today. Kind of went off a little bit, went through some real talk, but psychology is very important. I'm trying to drive that home. Hopefully I did a decent job. I appreciate you watching, guys. Have a great rest of your day. Take care.